In February, the Westpac Melbourne Institute Index of Consumer Sentiment fell by 1.3% to 100.8. So it's getting very, very much where the number of pessimists is basically equal to the number of optimists. I was surprised that the index actually fell this month. And the reason is that I thought improving news around Omicron and the spectacular news we've seen with the unemployment rate falling to 4.2% would have been enough to boost confidence. But what we didn't take into account was a big fall that we saw in how people assess their finances. So finances relative to a year ago was down 9.2%. Now that's fully offsetting the surprise 7.5% jump we saw in that index last month. So a net fall over the last 2 months. And then we also saw another 1.5% fall in how people see their finances over the next 12 months to be down more than 4% in the last 3 months. So why are the finances really worrying consumers at the moment? I think it's about the cost of living and it's about interest rates. So on the cost of living, we've already seen a 15% jump in petrol prices in the last 2 months, with 8% in the last month. And we saw the consumer price index for the nation announced last week. It was up 3.5% for the year, but the cost of essentials was up 4.5%. And when we looked at the various categories of people who are most affected by the outlook for their the outlook on their incomes, we saw renters, we saw low-income people, we saw retirees, and we saw young people. All the people who are really affected by that cost of living issue. The other one that was affecting their feeling about their finances was around interest rates. So 66% of the survey are looking for interest rates rising over the next 12 months. That's the highest proportion we've seen since 2011. It's up from 55% last month. And within that, 25% of the survey expect that rates will be up by more than 1%. As I indicated before, the outlook for the labour market continues to be very strong. The Westpac Melbourne Institute Index of Unemployment Expectations improved once again to be at its second best level since 2011. And that interest rate story was not enough to deter people's confidence in the housing market. So the Westpac Melbourne Institute Index of House Price Expectations surged by 8.7%. Now in the last 4 months it's fallen by a total of 9.2%. We're seeing that we're getting closer to the lift-off for interest rates, and yet people's confidence in that housing market and house prices remains incredibly sound. Some of the numbers for the individual states are quite stunning. So in Victoria, the house price expectation number was up 19%, New South Wales 4%, Queensland 7%. So what's going to be really interesting is as we move closer and closer to that time when the Reserve Bank raises rates, and we're expecting that to happen in August, whether this confidence in house prices can be maintained. What we did see, however, was the other measure of housing, time to buy a dwelling, was down by 2.4%. And that's not surprising. So since November 2020, it's down by a total of 37%. And we think what's driving that one is affordability. So when people expect house prices to be even higher, they're assessing them as being high at the moment. They're looking at interest rates will also affect affordability. The feeling around affordability itself is quite downbeat. So you've got this interaction between strong confidence in the outlook for house prices, but recognition that affordability is being really squeezed. So where does that leave the Reserve Bank? Well, the market was flirting with the idea that the Reserve Bank would raise rates as early as March. It's backed off from that. It's now confident about a June move. Back on the 20th of January, when most of the published analysts were talking about very late 2022 or even 2023, we surprised people by saying we thought it'd be August 2022. We stick by that view, but there's still a number of months to go, and the market is still well ahead of us on that issue. The other question is how far will rates go and when will they peak? That's very, very important. We're expecting that rates will go up to a total of 1.75% on the cash rate, peaking in the first quarter of 2024. That's not a bad outcome. And the reason why we think they'll only need to go that far is because of the high level of household debt. Interest rates rising are going to really impact that at the Australian economy, given our high level of household debt. But that's the big issue for global markets. Will central banks be able to stabilise rates at a level that won't be too overwhelmingly contractionary for the world economy? We're expecting that to happen. We're expecting inflation to be coming down in 2023, 2024. We're expecting the unemployment rate to be rising in 2024 to take pressure off wages. But of course that remains the big issue. Will that happen? Will central banks lose control of inflation and have to push rates well into that contractionary zone, which of course will have significant downward pressure on asset markets, both equities and housing? Thank you.